Okay, welcome back guys. Super happy to have Øystein back in the studio, sharing some lessons from the year and also forecasting a bit ahead. Øystein, thank you so much for joining again.
Good to be back. Didn't take a long time.
Didn't take a long time. Maybe it represents a bit of crazy year. Would you like to start and share the presentation and we can get more into it?
Yeah, sure. Let's do it. So we posted our new presentation out today. So I will just briefly go through the market. It's been a crazy couple of weeks. I said to Chris that, we're gonna have 5 slides and I ended up with 12 slides. So I will try to keep it short. Talk is cheap, as you know. I'm an economist, so I can tell you why it's cheap. Do you know why it's cheap, Chris?
Don't push me this question so early. It's too early.
Oh, okay. So of course, why talk is cheap is because supply is higher than demand. So with that, I think we can start. There was a disclaimer. You can read that if you want on the website if you want to invest in Flex. So let's start with US exports. This is the 3rd largest export market, and export volumes, they have skyrocketed since the slowdown and lockdowns in April to October. So, during the summer months, export volumes out of US fell as low as 200,000 tons a week. This is about 3 cargos a week. Now they are up at around 1.8 million tons on a weekly basis. This is about 25 cargos. So export volumes from the US have grown 8-fold. And as a result of the COVID-19 pandemic, gas prices worldwide plummeted. So flexible US cargos are at most risk of cancellation due to the highest short-run marginal cost, as well as they allow the customer to actually cancel the cargos. So as a consequence of this, about 180 US cargos have been canceled this summer and autumn. And we have also had some disruption because of the most active hurricane season on record, where particularly 3 hurricanes hit the exports plants in US, the Hurricane Laura and Delta, as well as the tropical storm Beta. However, from November, US volumes are more or less back at full capacity, and we are also seeing them increasing now with the expansion of Corpus Christi Train 3, which is now just recently taken the commissioning cargo. So volumes are up, and we'll look more at that on next slide, Chris. So if you look at overall the global volumes, it's customary to see that volumes tend to go lower after the peak winter months. But this year, this kind of reduction in volume have really been magnified by the COVID-19 lockdowns. Monthly export volumes have fallen from close to 36 million tons in January at the start of the year, down to below 28 million tons in June and July. So this is a 20% volume reduction, which is twice the reduction you saw from the OPEC cuts following the COVID-19 pandemic. So it's really massive reduction in volumes. And this really hits the freight market, as we have had around 35 ships for delivery this year, when you're seeing that volumes are down this much. But demand has picked up, especially in Asia. So we see on this graph that Asia's share of volumes have been growing. They have dealt quickly and swiftly with the coronavirus and implemented stimulus package as well. So in this period, the Asian market share of the volumes have grown from, below around 62% to now more than 75%. So, taking cargoes to Asia, of course, also involves more sailing distances. And if you look at this from a yearly perspective, 2019 was a bit odd year, where Asia's market share fell below 70%, around 69%. 2018, Asia's market share was like 75%. So then China was really firing on all the cylinders and taking a lot of the growth in the market. So in 2020, with this sharp increase in Asia growth, you know, we do see that we're going back to like 70%, but we're still well below 2017 and 2018 shares. So next slide, just to illustrate the same thing I said. Given all the cargo cancellation due to the low gas prices this summer, the expected growth this year will be around 5 million tons compared to 35 million tons last year. So last year, Europe really came to the rescue after a warm winter caused by the El Nino. And they did so also in the first half of 2020 due to their ability to take a lot of gas on storage. But as I mentioned, from second half of the year, it's been all about Asia. And you look at China growing around 8 million tons in 2020, India growing maybe like 5 million tons. So Chinese growth is as high in 2020 as in 2019, despite the pandemic. And keep in mind, you know, still 5 million tons growth in LNG this year. You know, coal and oil demand is down 6 to 8%. Even nuclear plants, nuclear power is down around 4%, driven by, you know, disruptions in France. That's why France is, you know, pretty high on the table here. They have been substituting nuclear power with LNG. So natural gas actually is also declining around 3%, but natural gas in the form as LNG is growing 1.5% this year, which actually exceeds the growth you have seen from renewables, which is only around 1%. Which is pretty amazing. So if we look a bit more on this on next slide, I can give you some, you know, view what this, you know, implications for the market, because Europe was absorbing a lot of volumes earlier in the year when Asia had a lockdown, and now cargoes are going to Asia. That means much less cargoes available for Europe, and Europe are now withdrawing gas at record levels. So you see this graph here on the left, withdrawals from European inventories, and you see that the gas inventories in Europe is declining sharply. And this is, you know, very good for the summer balances, because then Europe will have more capacity to absorb some of the volumes coming in the summer when demand is less. And this then, you know, would reduce the risk of further US cargo cancellation next year. So let's look on next slide. You know, what this has to do for the product prices. So, you know, we have gone from a market in the first half of the year where you had supply-driven market, where Europe was more like the central bank of gas. They had to be the buyer of last resort, filling up but you know, this capacity is not endless. So once you got to levels where inventories were piling up and full, we had to cancel cargoes, and prices, you know, went as far as $1 in Europe, below $2 in Asia, and at $1.4 in the US. And now we have gone into a second half market where Asia it's demand driven, and this is really rallying the gas prices. And we know yesterday we went from the January contract for Asian LNG price, it closed at around $12. And then we went to February contract yesterday, and that's also at $12. So we've gone from $1.8 for Asian gas prices to $12. So it's really high prices. But, you know, oil is also gone to $50. So this is boding well for the shale players in the US. So Henry Hub has actually declined from $3 to around $2.50. So you have gas in US being having a cost of $2.5. And then you can ship it to Asia, sell it for $12. This creates a huge arbitrage spread, and that's why cargoes are going to Asia and people are paying a lot to freight it. But, you know, given the fact that Europe is also drawing their inventories, the forward prices for gas next year is also increasing, because people see that gas will be more in demand, and the spreads now are actually I put in here gap year, where there's a pretty big gap between the Henry Hub price, which is around $2.50, and TTF, the European price, and then the Asian price. So we do expect, you know, these really high gas prices to come down, but still they will converge at around the contract price for gas, which is this kind of oil link price. So typically gas is being sold at a discount to oil, 15 to 30% discount to oil. But right now it's been sold at a huge premium to oil. But, you know, this will normalize, but still at much better levels than we've seen this year. So if you look at next slide, maybe then. So, you know, this means that a lot of cargoes have to be going to Asia, and it's creating a lot of congestions because the capacity in Panama is limited. And keep in mind that the shipping market for the two other segments that use Panama Canal right now are also very on fire. That's container traffic, which is the biggest part of the traffic. Those ships are packed with iPads and consumer electronics to replenish stores in warehouses, and people are crazy these days on Amazon buying a lot of stuff with all the monies they are not able to spend on holidays. So of course containers are on fire. You are not able to get even steel containers these days. And then LPG, which is also a gas product, that market is also on fire with $100,000 plus on the rates. So you should look into Avance Gas, which is a affiliated company of Flex. So a lot of people are competing for these slots, which are limited. If you have a pre-booked slot, you will get through, but a lot of ships are just going to Panama and waiting for a spot slot. But these slots are now being sold on auction, and it's hard to compete for their willingness to pay with a container ship packed with expensive consumer electronics. So waiting time is gone up quite a lot. We see a lot of ships waiting for 10 days. And then if you're waiting for 10 days, you might as well go through Cape of Good Hope or the Suez Canal to Asia. It takes you 14 days, but then at least you know when you will get through, and you avoid paying the Panama Canal duty. So that is what's happening. And if you look at the graph on the right, you will see that a lot of ships now certainly using the long way around Cape of Good Hope. So this also magnifies the freight market, because first you have the pull to Asia, and then you have those ships sailing the long route to Asia on top of that. So it's really good for the shipping market. And you know, this is the average transit hours. So right now, if you look at the projection for the next couple of weeks, you know, the range here is like 150 to 250 days expected waiting hours for spot slots the next couple of weeks. So this will be firm, and it's not like this problem is going away. The capacity in Panama is finite. So there will, when there is a lot of traffic, some ships will have to take the long route. So good for the freight market. So maybe next slide. And then, you know, surprise, surprise, what happens when Asia wants a lot of cargoes and ships are going the long route? Well, liquidity of ships dries up. So this is from Affinity on Friday. They had a prompt vessel availability. It's 000. No ships available. You have to wait a bit for a ship. And this is just ballooning the freight rate. So this is the seasonal freight rate the last couple of years. And we are today, you know, it's hard to tell because there's not that many fixtures. You know, if there was a lot of fixture, then a lot of ships would be available. But Fearnleys put the number at $175,000 yesterday for Amegi XDF ships, the new ships, the ships type which the Flex fleet consists entirely of, which is much higher than the last couple of years. Because what people don't realize, you know, it's a bit different market, because we have a market where winter weather in Asia is actually very cold, which hasn't been the case the last 2 years. And then we also have demand-driven growth. And on top of that, you have some supply disruptions as well. So it's a really firm market with, you know, February JKM product prices at $12, which I haven't seen for many, many years. And especially in arbitrage spreads, which we haven't seen since 2013-14. So maybe then looking at the next slide. So with the backdrop of a firm product market and Asian demand, you know, we can unlock a lot of potential volume growth next year. So the Energy Information Administration in the US, they expect US volumes to grow around 16 million tons next year. This is at 88% utilization. So still then you would expect 85 cargoes or so to be cancelled next summer. If you look at product prices, forward prices, you shouldn't really be cancelling cargoes next year. So if you add those 6 million tons on top of that, you have more than 20 million tons growth potential from US. And that alone would absorb the whole order book for 2021. We talk about a big order book for 2021, probably around 50 ships for delivery. But it's not like 50 ships are delivered 1st of January. They are spread out through the year, although most of them in the first half of the year. But you know, if you have 20 million tons out of the US, you would probably need around 40 ship years to transport those volumes. So that's like the order book for next year when you take into account that they are delivered during the year. But you know, it doesn't stop there, because we also have Prelude starting up. That's 3.7 million tons in Australia. Gorgon is up, train 2 is up and running after being shut from May to November. That's 5 million tons on that train. So there we have adjusted it for a yearly basis to around 2.5 million tons. Then we have the Russians opening some new plants, and then the Egyptians, they are back in the market. ITCU has already started, and then there came an announcement recently that they will also start Damietta plant first half of next year, which has a capacity of 5 million tons. So, you know, energy aspect, they expect growth to be 24 million tons, but, you know, it could be more or could be less, but, you know, pretty big volumes that can come to the market next year. And if those volumes are heading to Asia, like we're seeing now, that's pretty good for the shipping market. So I think, you know, that's, I have one more slide, I believe. Yeah, so, you know, it's, you know, market is very good now, but it's not like we're losing our heads. Product prices will come down, freight rates will come down, normalizing, but LNG is more about a long-term game. I said, you know, we are growing 1.5% this year. It's even quicker than renewables. And but also think about it, you know, we're growing quicker than renewables, and this is percentage growth. So it's even though renewables is from a lower base, LNG is still growing quicker. So you know, if we are to decarbonize, and you know, there's strong support for that now, you know, the quickest way to decarbonize is to shut down all these coal plants, like they've done in South Korea this winter. They shut down 16 coal plants from 1st of December in order to clean up the air, pollution mostly, but also reducing carbon emissions. So in that, you know, case, if we want to really do something, we really have to close a lot of coal plants, and then LNG will grow very rapidly. So this is a slide from BP's Energy Week. They have a business as usual. So let's say we don't do anything with CO2 emissions, then of course, surprise, surprise, you know, LNG growth will be pretty big. You know, this is 2018 levels at 425 million BCM. I believe that's around 320 million tons in 2018, and you will grow to, you know, 800 something by 2035. So doubling the market by 2035. And even more so in 2050. But if you're doing rapid decarbonization, this means pricing carbon emissions, getting rid of coal, then actually LNG will grow much quicker. So in such a scenario, LNG demand in 2035 will actually exceed 1,000 BCM. So you can divide that by 1.35-ish, and you end up at, you know, 700 million ton or so. So it's a really, you know, rapid market growth we do expect for LNG, as it's the quickest and easiest way to decarbonize today. So then last slide is just that we want to say Merry Flexmas, and I think we can do some Q&A then.